everybody. Jake McAfee, host of the Fort Wayne Local Podcast. Welcome to another episode. Today, we are joined by real estate investors Jay Redding and Kyle Cassidy of JMJ Real Estate Services. Gentlemen, thanks for joining me today.
Thank you.
Thank you. Appreciate the opportunity.
Yeah, definitely. So we'll go in on a quick background and then we'll jump in on what note investing even is, because I think a lot of people out there have never even heard of it. So Jay's the manager of JMJ, and he's a mentor, speaker, and coach both locally and nationally. His background is in pharmaceutical sales, and he had some success at Division I track and field. So we got an athlete in the house. That's good to know.
Long time ago.
And he has his Bachelor of Science degree in education from Taylor University, and a Master's of Science degree in education from IU. Enjoys running, reading, and play farming. What's play farming?
I grew up on a hog and dairy farm, so that's just getting dirty in the dirt. That's it. Hobby farming. That's what it is.
Okay. All right. That makes sense now. That makes sense. Okay. And Kyle's the operations manager, and he joined JMJ in 2014. Bachelor of Arts degree with business management minor in 2011 from Taylor University. Kind of oversees the daily operations, and enjoys biking and movies. So, okay. So for those who don't know, can one of you guys or both of you kind of give an overview of what note investing even is?
Sure.
Yeah.
What is that? First of all, just to give a little background of how our experience is, all right, and I'll answer your question. It's a simple question, but it's not such a simple answer. Our background in the real estate, we've got about 48 doors that we self-manage, rentals. We do 3 to 5 retail flips a year. We buy tax liens, and then we buy, create, and also sell mortgage-backed notes is what we do.
Yep.
And a note is really, it's a very simple question, but just like in real estate, and you say, hey, I'm a real estate investor, all right, that could include 1,000 different angles. Okay, as far as what you do, you could be a landlord, you could be a flipper, you could be a wholesaler, you could be Airbnb. The same thing happens within the note industry as well. A note, when we're talking notes, we're talking mortgage-backed notes directly is what we're specifically. There's notes for cars, there's all kinds of notes that's out there. We're talking specifically mortgage-backed notes. Mm-hmm. The simplest would be, as an example, would be, say, when someone goes and they want to purchase a house, they go to a mortgage originator, a loan officer. They want to get bank financing or financing of some sort. They don't have all the money to pay cash for the property. Well, the promissory part of that, the promissory note, is the terms of the agreement, all right, and how they're going to pay that back. And then the other part of that, at least in Indiana, is the mortgage, which is the security agreement that secures the note, which essentially states that if you don't abide by their terms, we can take the house. The house is the collateral for the protection of the lender on the loan itself. Well, many times what you'll find is once you close on the loan, maybe 3-5 days, maybe a couple of weeks, you'll get a notification in the mail that your mortgage has been sold. Well, what that means is that you have the loan originator who originated the loan, or the company that originated the loan, and then it has been sold off into the secondary market. That could be purchased by a hedge fund. It could be purchased by a private equity group, could be purchased by the federal government. And many of those are actually bought and sold on Wall Street, okay? That is the basis or simple part of how it works. We do not play in that market. We play in a market where it's called the secondary market, and it's essentially, think of it as a scratch and dent type of an appliance. You go to the scratch and dent store, it's not perfect. That's the realm that we work in. So these notes tend not to be perfect. Maybe there's something that's happened. Maybe there's been a modification that's taken place on the loan, and it doesn't necessarily fit Wall Street criteria, in that respect. And those become available to much larger hedge funds and things, and private equity groups that buy them in the millions, okay, of dollars, multiple millions of dollars. And in time, they'll filter down to smaller private equity groups, and then down to mom and pop and us that are our size, okay? And we can buy them on a couple different platforms that's out there. We can buy them directly in relationships to some private equity groups. So these are, think of it as the scratch and dent loans. Doesn't mean necessarily that they're bad loans or anything like that. It just essentially, if there's some blemish, there's some hiccup that's taken place. And in most situations, people have gotten back on board, and we can take it and buy it at a discount so that it becomes more profitable for us.
Yeah, so, most of the time, it just doesn't fit what the hedge fund or the bank is wanting. You know, it might not be in the right state. It might not be in, you know, the credit score might not be high enough for their risk assessment to deem it a viable note for that.
Or maybe they've got too many loans in one particular part of the country that they don't want. So they want to balance our portfolio out.
And could it be because you guys maybe have more discretion where you can look at each individual note and they're trying to buy in bulk and don't have the time to like comb through each specific situation, where you can say, maybe, for example, you know, maybe someone had job loss, got behind, got a new job, got caught back up. Is that like a good example of what something you might invest in?
Good.
Yep. Yeah, exactly. All right. They've been a good borrower and good payer in the past. There's been a hiccup. Now they've gotten past that, and now they're back on track. We can modify that loan, or that loan may have already been modified to help them to be able to get into a position where they can handle the payment a whole lot better, and then, you know, whatever they may have accrued or have to pay, we could put that on the back end of the loan. I mean, we would own the note. We could do with that and structure that however we would like to restructure that in helping the borrower to stay in the home.
Okay. I think that makes sense. And then, so what got you guys started in this? Because obviously, I feel like most investors, it's like buy and hold, rent it out, flip, wholesale. Those are like kind of the big three. What got you into note investing?
Sure. I'll let you do that one.
Yeah. So we, like he said before, we have probably, I think we're at 40 some doors right now.
48. We're 48 doors right now.
48 doors, about 45 properties. And we've been doing that Jay's been doing it for 15 years. You know, I've joined him, you know, about 7-8 years ago. So, and we still have rentals. But we were getting to a point where we're like, okay, we self-manage right now. Mm-hmm. So we, as you may know, that's quite a bit of time. That's a lot of work to self-manage 48 doors. And looking down the road, he's, you know, Jay's looking to retire, looking to be out of the day-to-day activities. I'll be stepping in more into ownership role of running the higher up part of it that he is doing, not necessarily the management part. So the question became, okay, do we really want to bring in another employee? Do we want to hire out our property management and lose some of that income? What was our direction we were looking at going? And we had heard about notes before, but never really, you know, looked into it deeply. And we started kind of reviewing and watching some videos and realizing, oh man, this could be a good fit for what we're already doing, and gives us the flexibility to not have to worry about a day-to-day operations type thing. And so Jay headed down to a note conference. I was out of town that weekend, so I wasn't able to go. And he came back and said, well, I bought the course and we're jumping into notes. I said, oh, okay, I guess that worked out well.
I love it.
So I had read a few books on notes and brought it up to Jay, and he's like, okay, yeah, we'll take a look at it. But what we found was it fits perfectly with our model. We had already done a lot of lease options as well. And this is I won't say an advanced form because it's actually somewhat simpler, but it is another avenue of getting owner financing, getting people into the house, and it fits really well with stuff we've already done. And we've started now, we've been doing it actively buying now for 2 years, and it's been it's been gone really well for us. So
okay, so you found a course, because I'm a Bigger Pockets fan. I've been listening to them for a long time, and I know they mean it in a good way, but they constantly are ragging on courses, because there's a lot of people selling bad ones. I know that's why they do it. So you went to a course that actually was a good one and helped, kind of launch your journey.
Yeah, we definitely did some research on who we wanted to follow, and who we wanted to put our trust in and our money to. Based on that, it wasn't just a blind Google search note course and went to the first one. We did quite a bit of research, and we came out with Note School with Eddie Speed, and that worked out very well. We personally, unbiased opinion, but we personally think he does this the best in the country for what he provides to his students and all that. So we went to one of his conferences down in Indianapolis, and we're right on board. So
okay, that's great. So would you say, what type of investor, we're probably going to be piquing some interest here in this interview. What type of investor should consider note investing?
A lot of that will depend upon what they want to achieve in their investing. Okay, you could be passive on this and make a good 6 to 8% return on a consistent basis. It's consistent, predictable, and has an asset. I mean, you would own the rights to collect the income off of that, the payments. All right. So someone who wants to be passive, they could certainly team up with us. We borrow against, this is what a lot of people don't realize, but you can pledge the note as collateral on a loan. The banks do this all the time, back and forth. All right. And you can do it on an individual basis as well. And we certainly have done that. But you can be a passive investor that's just looking for a consistent 6 to 8% return. We could do that all day long. The other thing is, if you want to be more active, then you need to certainly learn a lot more about the business. We are certainly active investors. We're not passive. We are actively buying both performing and non-performing notes as well. The other part of this, there's creative financing that's involved with this. There is non-performing notes, be able to pick up a note, get it to re-performing. Okay, you're buying the non-performing at a much greater discount than what you would on a performing note. And we can try to keep the borrower in the house, and sometimes it's just not feasible. But there's a lot of different workout things. So if they want to be an active investor, then they should probably come to our once a month meetings that we have on Zoom, to be honest, to start learning some of the ins and outs. And we have a number of education videos that's on our website that they can, that covers the basics. And then we make ourselves available once a month to just help people on deals that they may be working on, or whether it may be someone that's a landlord that's looking to sell their property, say, to their tenant, to make sure that that's structured correctly in a way that it's profitable and that it has value into the secondary market, and that they are staying compliant with all the rules and regulations that has to do with seller financing, particularly Dodd-Frank rules that many people just aren't aware of. I mean, the borrower's got to be able to meet certain standards there. And the penalties for not following that are pretty severe. And we can keep people out of a lot of hot water and helping them to do that in a way that is structured correctly.
Okay. And so I'm almost picturing someone for the passive route, maybe someone higher income, like in the medical profession, something like that, like a doctor, something who has, a good income and maybe wants to diversify and park some of it, but doesn't want to, pour in the hours and hours studying and researching and stuff like that. Right. You're saying they can partner with someone like you, provide the capital, and then you put it to work for them.
Yep. That's exactly right. And that's who we deal with right now. Exactly that.
Okay. And then it's funny, it's a good lead into my next question. So I obviously being in real estate, I know there's a lot of laws and regulations. How do you guys learn about that? Like, how do you know how to avoid, crossing a line or something like that?
That's a good question.
It is a great question. Some states are much more aggressive than others. I mean, a lot of it will depend upon what state that you're going to be investing in. We primarily invest in Indiana, Michigan, Tennessee, and Alabama at this moment in time. And the reason being is because the laws are much more favorable there. We're familiar with that. We have contacts in those areas as well. So we kind of have a team spread across those states that make it very, very, very helpful. We actually have sat down with a couple different attorneys to do the research to make sure that what we are doing and how we are doing it are compliant within each one of those states. There are laws on the books, and you have to be, we may own the note, but we do not service the note ourselves. We place the note with a licensed servicer that is a debt servicer in each one of those states, or is licensed to collect debt throughout the entire country and service these loans, because there's so many rules and regulations that have to be followed, and I don't care to learn all of those, to be quite honest.
What does that mean? What's a servicer?
Yeah.
Yeah. Go ahead, Kyle.
I was going to say, think of it like a property manager. Exactly the same type of thing. They will, they talk to the borrower. They take the income and then send it to you. They take care of all the escrow, so all the taxes, all the insurance. If that note is escrowed, they take care of all that. Send out the appropriate tax forms come tax season. Basically do everything that you would get when you do a bank financing loan, when you do any type of loan for a property. That's what they do.
Okay, so you guys are strictly finding the note, buying it, but not managing. Like you said, you're having a servicer take care of that.
Right.
Correct. Okay.
Yeah, that's exactly right.
So, I'm sure
I should say they manage it, but we have all the say on what we own the note. So we have, say they get behind 60 days, we could, if we wanted to, adjust that term, adjust that rate, whatever we wanted to, because we own the note. We instruct the servicing company on what to do. They don't decide any of that kind of thing.
I got you. So just like if you had a rental and someone fell behind, you may want to work with them if there was mitigating circumstances, or you could say, let's start the eviction process. This is kind of the same thing.
Right.
You still have control.
Yeah, exactly. They come to you.
And instead of an eviction process, we would start doing, every state is a little bit different on how the notification takes place, but we would essentially start the foreclosure process when they get at least 90 to 120 days behind in that respect.
Okay. And so I'm sure now a lot of people have heard this and are thinking it's set it and forget it, and you can make a ton of money. What are some of the pitfalls to note investing? Like what's something to watch out for going in?
Well, there's really, when you're an active investor from our standpoint, there's about 6 areas that we really look at. We typically are not buying loans that were just newly originated. All right. We want to purchase loans that have some pay history behind them. So pay history becomes a very, very important factor. It doesn't guarantee future success. All right. But it certainly, if history is any indicator of what the future would look like, then it is a solid point from which we work from. We also want to make sure that the value of the property is that we have some equity position in there to help buffer in case anything goes wrong. We want to see what the down payment is. If you're only looking at a 3% down payment, and they've borrowed $117,000 and the house is worth $120,000, we're not interested in that. Okay. Yeah. Okay. So we typically want at least a 20 to 30% equity position into the home. All right. So we're definitely having some safety values there. We want to make sure that if it has been assigned, or I should say, if the loan has been assigned to a new owner, we want to make sure that all those legal documents are in place. We're able to review with signing NDA, et cetera. We're able to review the collateral file, which has all the loan documents, all the underwriting, all that type of stuff that's involved there. So we're looking at all of that. We want a particular level of pavement that makes sense for what we want. Particularly because you're looking at a servicing fee that's somewhere between $30 and $35 a month that you're going to be paying. Well, if a monthly payment's only like, $150, $200 a month, that eats into your profits tremendously. Okay, so we're looking at our monthly payments ideally at least above 500, but between 500 and 700 a month is what we're basically looking for their principal and interest payments in that respect. So
okay, so you keep it pretty conservative. It sounds like you're not trying to do a ton of volume. I mean, obviously volume is good if it's the right volume, but you're
correct.
More selective on what you're looking at to make sure you don't overextend.
Yes, right. And one of the things that's really important is that you are allowed a due diligence period in which to make sure that there's no liens on the property, or if there is a lien on the property, it's behind the mortgage, that there's nothing that is superior to what the mortgage would be, all of those types of things, making sure the taxes are up to date, all the escrows are right. So it's basically going through the file and going through everything with a fine-tooth comb to make sure that everything is in line as it should be, and that the documents are written correctly. Included with this would be land contracts in addition to notes and mortgages. So we have purchased land contracts and then converted them over to notes and mortgages. And I would tell you, some of the things you see written in a land contract is just crazy. Okay, there's no way on this earth is it enforceable. So we get it. So it's the way it should be.
And again, it's no different than buying a rental property. The only difference is, when you go through a rental property, you're looking at the furnace, you're looking at the structure, you're looking at the roof, the flooring. Okay, this needs to be fixed, this needs to be updated, that kind of stuff. The only difference is, you're looking at the house, but you're not looking specifically at those things. You're now looking at the paperwork, at the borrower, at the, like Jay said, the amount of down payment, the pay history. There's just different avenues, things you look for to make sure that what you're purchasing is going to bring you the return that you're looking for.
Okay. So. And why is it desirable over owning rentals? Like why not just stick with rentals? The market's hot, a lot of people are jumping in, the city's growing. Why notes?
Sure. The big thing for us is I guess twofold. One, it is, I'll say it's mailbox money. So for us, we manage our own portfolio. So there is a lot of activeness in that, in terms of managing our own rentals. Whereas with a note, it is strictly, once it's set up with the servicer and they're performing, we've bought, we've bought probably 5 or 6 notes that are just straight performing notes. Every month, all I do is I check to make sure that they paid. I write down the amount, the interest, all that kind of stuff, record it, and then wait the next month. And that's it. It comes into our bank account, and that's it. The other big thing is with a rental, you have maintenance, you have vacancy, you have upkeep, you have taxes, you have insurance. All those things you have furnaces, you have roofs, you have windows, all those things can be damaged, updated. You have tenants that just don't care about their property. Whereas I'm sure a mentality wise of someone that owns their own home versus a tenant is a huge difference in terms of how they upkeep their house. And so there's, every month I can look and see, okay, I'm getting $600 a month in principal and interest. Yes, I can't move that up in say a year or two because, just like rents have gone up. However, I also don't have the taxes that are going up. I don't have the insurance that are going up. I don't have the maintenance items because, you don't call the bank when your toilet isn't flushing. You know what I mean? So, sure. It's a give and take. We still have rentals and we still plan on keeping our rentals because there is some value in having property and having rentals for sure. But this is just another avenue of investing that we found that fits our model that is much, much more passive for us than rentals are.
And do you find that it's more scalable? Is that the idea, that you're going to be able to scale
exactly
it?
Right.
Okay.
Yeah. You can manage 100.
That's the other thing.
Yeah, you can manage 100 notes a lot easier than 50 rentals.
And me, just myself could manage 100 notes. You know what I mean?
Very much so.
100 performing notes versus me just managing 100 rentals. That's quite a bit.
Yeah.
So
I was in property management as a new agent, and I tapped out at 8 and just got rid of all of them. I was
That's
like,
enough.
no more, no more.
that's how it usually goes.
Yeah, that was enough to learn never again. So, okay, I've been wanting to ask this question since we started. If you guys are open to it, are you able to share where either you made a mistake or a deal went bad, or, you know, you thought something looked good and then you got into it and realized it wasn't what you thought?
Boy.
You know, I was looking and thinking about that. To date, we've not had a disastrous one at all.
That's great.
Okay. All right. We've had a couple who've gotten behind. Okay. And then they've gotten back to where they need to be. Okay. We've had a couple on the real estate side. We've had a couple close calls. I would say that definitely there. But on the note side, I really can't say that we have had anything. There's been nothing. No one has stopped paying. Okay. Everyone continues to pay. I think part of that, we've made a good selection of the notes that we have purchased. Yes, we are conservative in our nature, in what we do. I'm a little older, so I don't want to be redoing things again down the road, to be honest. Okay. We have purchased a non-performing note, and we look to be doing more of that down the road. Now that's a little bit more active in that respect. And I'm assuming the flip side of that would be then, you know, what's your home run? That was a home run. Okay. That was one where we picked up where the borrower had defaulted because he passed away. Actually, he was able to purchase that from a hedge fund, and we basically took it to actually it had already been foreclosed on, and we just took it from foreclosure onto the sheriff's sale and made a 25% return. So which was pretty good. Now the downside of that one is that we bought it thinking it'd be a 60 to 90 day turnaround. Well, right after we bought it, the courts all shut down because of COVID.
Oh.
So we held on to it for 8 months, okay, before the courts opened back up. But one or two things would have happened. It was a house that was in great condition. All right. It was actually local here, so we actually just used our own property management service to make sure that the grass was mowed and everything like that. Now we couldn't go in and do anything because we don't own the property, but property preservation services, we could certainly do that. And we would either gotten the property back with a huge upside, or the total collectible balance was certainly high enough between that and what we purchased the note at that we made a very nice, very nice return on.
And the nice thing of that, you know, versus buying a very rundown property and fixing it up yourself was yes, it was local. So we had our own property management company mow the yard and that kind of stuff. But that is all easily hired out, you know, even if you're not local. But again, we gave it to our attorney. He took it through the courts, went through all the documents, told us what was going on. We did, virtually nothing, and just took it through the courts and made our return, and no other money than what we used to purchase it at a discount. Yeah,
that's great. And I do want to circle back. First of all, I'm glad you haven't had a huge mistake. I wasn't like rooting for one, but
well, thank you. I appreciate that. But here's the worst thing that would happen. The worst thing would be we've got one that's paying, it goes non-performing. You've got exit strategies. And we go into it looking at what's our exit strategies. They're either we can modify the note, we can forgive part of the debt if we want to and help keep them in there. If they don't want to or just can't make payments, then we can do a deed in lieu. All right. Or ultimately we can do a deed in lieu, which is the cash for keys, or ultimately we just go through the foreclosure process and take it through the sheriff's sale. And the bottom line is that we bought it at a deep enough discount to the value of what the property is. It's called investment to value, a little bit more technical terms, but your investment to the value of the property, that you've got plenty of equity to protect the money that you have into it. It just takes a little longer for it to come back, but you are protected. That's equity protected.
That's what I wanted to get at was,
Sure.
I've heard you say that you consulted attorneys before getting started.
Sure.
You're talking about big equity positions, good size margins. I just want to make sure everyone's hearing that. Cause again, we're kind of doing this interview to expose people to this. And I feel like sometimes people tend to chase easy money, even smart people. So I want to make sure they're hearing this loud and clear, like due diligence was done. This was very calculated. And that's why you haven't had, a big one. So tell me about your guys' book. You just released a book, correct?
Yes, that's right. Yeah, actually, yeah.
We actually got it.
Add in handy. Look at that.
There's our ugly faces. There you go. Scan the mice away. There you go.
So, who's the book for?
It is really geared for someone that literally knows nothing about note investing. Okay, this is put together from the standpoint we're making the assumption that you know nothing. Okay, is what we're making the assumption is. It's an introduction to note investing. It covers the basic concepts, the basic principles of what we're doing. Some of the market dynamics that have taken place here recently with what's called oftentimes the burnout landlord, mainly the individual who's maybe has 4 or 5 rentals that's out there right now. And during all this COVID stuff, they may not have been paying. And, there are landlords out there that are just done with it. The thought it's just, they're fed up, not so much with the property. The property is fine. They're just fed up with the issue of dealing with the tenant with what has happened, and they're looking for an alternative. Is what they're looking for. So it kind of addresses that and what's going on in the marketplace, and just the basic things about the business. There's a lot of different angles that can be done with the business, and it kind of covers some of those different angles as well.
Yep. And the other person, it's very easy. Very easy. Yeah. The other person is someone who is looking to be more of a private investor or a passive investor, not looking to be involved with it, but still wanting to understand what it is they're investing in. And it's, like I said, it's a very easy read, very understandable, and it allows us to show them, and then they can come to us with questions afterwards, and much more of a structured guideline of what to look for.
Okay. And where can people get it?
Yeah, we should be able to have a link for you. It's at CassidyInvestments.com is the website. That's our note company. And there should be a link up there to sign up for our newsletter. And when you sign up for our newsletter, you'll get the copy of the free book.
You can get the free digital copy to be able to read.
Okay. Yep. And I'll link to it when I post this. And so how can people connect with you guys? How can they learn more about you guys personally?
Yeah. So CassidyInvestments.com is our note website. JMJRealEstateServices.com is our real estate website that has a little bit more about us and where our backgrounds, some testimonials, some tenant testimonials, as well as private investor testimonials that we've dealt in the past. Some ideas on what we flipped, because we also flip houses here in Fort Wayne. So there's some examples of what we flipped, as well as just any of our rental properties, all that kind of stuff. So those are the 2 main websites that you can go to and visit.
Okay. And just so anyone listening knows, I don't know you guys, we haven't met personally, but I did some digging and I kind of asked around to vet you guys before I did this, and people spoke very highly of you guys. And, I want to make sure I share that publicly, both just for reputation, but also so you get to hear it. Like people, think very highly of you in the marketplace. So, I would encourage anyone who has more questions about this to reach out. So gentlemen, I want to end the same way I end every interview. What's your favorite thing about living in Fort Wayne, Indiana?
So I came from, I grew up in Chicago. So I grew up in a large suburbs of Chicago. So I grew up with a lot of options around me. And then went to school at Taylor University, which is pretty much middle of nowhere. And then coming to Fort Wayne, it was like, okay, this is a city, but it is a small town city. Now, granted, I live out in Grable, so it's Amish territory, so I like the quietness. But even coming into the city, you get the city atmosphere, but it's much smaller. It's much more simpler.
Sure.
Than Chicago, for sure.
Yeah.
I would answer that somewhat similar along the same lines, is that I think Fort Wayne provides you just about all the major amenities that a large city does, but in a much friendlier environment, and I'll say safer environment too. All right, in that respect. Fort Wayne is it still is considered, in my eyes at least, a small community town, although we're 300,000, I think is roughly where we're at right now. But it still has a small town atmosphere, a small town feel, but it has a lot of great things that's going for it for the size that it is right now. And I think Fort Wayne is truly starting to get recognized more and more on the national level for the quality of things that are taking place in this city, particularly when you're looking at some of the different ratings and things along that line. So I grew up around here. I grew up down in Wells County. So seeing over the years how much that Fort Wayne has transformed and how much it's grown, I'm happy to be part of the community.
Yeah, I completely agree. I was in Orlando, Florida. I'm from here, was in Orlando, Florida for 12 years and then came back in 2019, and it's a completely different city than what I left. And the excitement is incredible. So, all right, well, gentlemen, thank you so much for your time. It's very clear you're experts and very passionate about what you do. So I'd encourage anyone out there, reach out to them if you have questions. And again, thank you very much.
Thanks for having us.
Appreciate it.